All right, let's dive right into this explainer. Today, we're unpacking the massive, and I mean massive, structural transformation of Honeywell Technologies. We're going to figure out exactly what's going on with this industrial giant, and more importantly, what is really driving its falling stock price. Because right now, it's a wild story of corporate reinvention, shifting portfolios, and some deeply contradictory financial signals that have the entire market completely on edge.
So right off the bat, we're faced with this huge paradox. We've got incredibly strong, rock-solid fundamentals that are just completely clashing with a plummeting share price. Now, it's not often you see a company reporting overwhelmingly positive forward-looking data while at the exact same time suffering through a severe, sustained sell-off. It really begs the question, right? Is the market seeing some fatal flaw we're missing? Or is it just entirely mispricing a hidden opportunity?
I mean, despite the stock's recent drop, free cash flow in the second quarter absolutely exploded. It jumped 300% year-over-year to $456 million. Operating cash flow shot up by 201%. And it doesn't even stop there. Alongside all this massive cash generation, there was a 16% jump in orders and a staggering $20 billion backlog. Seriously, these are the kinds of numbers that usually send a stock soaring, not sinking.
To make sense of this whole situation, we're going to quickly look at the new company structure, break down the bull case, tear into the bear case, and then land on our final verdict.
Okay, part one, a brand new company and its post-spin identity.
So, to understand what's happening today, you have to realize that on June 29, 2026, Honeywell basically concluded a multi-year portfolio restructuring. This was a defining moment for them. They completely spun off their aerospace technologies division into its own independent company, which now trades under the ticker HON. And at the exact same time, they executed a 1-for-2 reverse stock split. Basically, if you don't adjust for this massive structural change, any historical revenue or earnings comparisons you make are going to be incredibly misleading.
We are just no longer looking at that old sprawling conglomerate. The new Honeywell Technologies is a leaner, much more focused, pure-play automation company. The whole strategy here is to benefit from hyper-focused operations, disciplined capital allocation, and a lot more financial flexibility.
This new identity rests entirely on three foundational pillars: building automation, process automation and technology, and industrial automation. By taking their deep domain expertise and pairing it with decades of data, management is basically betting that these three segments will lead the entire industrial sector's transition away from standard automation and straight into full autonomy.
All right, let's move into part two, the bull case. And honestly, some of these future indicators are explosive.
The crucial thing to grasp here is the difference between current sales and future visibility. Sure, current organic sales only bumped up about 4% in the second quarter, but adjusted earnings per share up 10%. And more importantly, remember that 16% leap in orders and that $20 billion backlog? Why does that matter so much? Well, because today's orders literally become tomorrow's sales. That backlog provides tremendous visibility into future revenue growth, and honestly, it seems like the broader market might be completely ignoring it.
Management is so confident that they recently raised their 2026 outlook. And here's the core of the bullish argument. This is wild. Management expects modest, top-line organic sales growth of just 3 to 4%, right? But they are projecting a 25% to 29% surge in adjusted EPS. How on earth is that mathematically possible? Well, it all comes down to aggressive margin expansion, ruthless productivity improvements, and massive operating leverage. If they pull this off, that is an incredibly powerful earnings engine.
A huge driver of this growth is the building automation segment. Right now, it is the absolute shining star of their portfolio. It generated over $2 billion in Q2 sales, hit 9% organic growth, and boasted a fantastic 27.1% profit margin. But here's my favorite part. They are successfully cashing in on the massive AI infrastructure boom without having to design a single AI chip. Think about it. The company everybody associates with basic thermostats is actually powering the future. Data centers require intense, next-level energy management, liquid cooling, and complex fire safety systems, and Honeywell is perfectly positioned to supply all of it.
Reflecting those strong fundamentals, Wall Street is eating this up. Out of 21 analysts, we're looking at 15 buys, 8 holds, and only 1 sell. They're predicting an average 12-month target of around $262.95. Compared to where it's been trading recently, that suggests nearly a 22% potential upside. So for sure, the institutional consensus definitely sees this growth story as intact.
But let's flip the script. Part 3, the bear case.
Let's completely destroy that bullish argument. Because here is the brutal reality. The stock has plummeted 51.5% over the trailing 6 months. It has severely underperformed the broader S&P 500, and it's lagging way behind pure-play competitors like Rockwell Automation and Emerson Electric. The market is clearly heavily penalizing this stock, and we really need to understand what exactly is triggering such a persistent sell-off.
Well, a major drag on the company right now is the process automation segment. While building automation is out there booming, process automation actually saw organic sales shrink by 1% in Q2, segment profit dropped 4%, and margins contracted by 180 basis points. What happened? Mostly it was hit hard by project delays, lower refining catalyst shipments, and reduced customer demand tied directly to ongoing geopolitical tensions in the Middle East. So not every part of the new Honeywell is growing at the same speed, and this segment is flashing a pretty big warning sign.
And then there's the elephant in the room, the balance sheet. The company is carrying $31.5 billion in total debt. I mean, that is a staggering amount of leverage, literally enough to buy a professional sports league or two. It's largely the result of the funds they had to raise to execute that aerospace spinoff. Pitted against that mountain of debt, their $8.8 billion in cash looks, well, a little modest. Elevated interest expenses, which hit $363 million just in the second quarter alone, could put severe pressure on near-term profitability if their operations stumble even a little bit.
All of this leads us to the ultimate risk here, the valuation. At roughly 26.3 times forward-adjusted earnings, this stock is absolutely not a cheap value play. You are paying a massive premium multiple for a company that is only generating 3 to 4% top-line sales growth. The entire bull case relies almost completely on them hitting that 25 to 29% EPS growth. If their aggressive margin expansion plans fail, or if revenue growth slows down even a fraction more, this premium valuation is going to quickly compress, and that could send the stock tumbling even lower.
Oh, and real quick, we need to clear up this whole dividend collapse illusion that's been freaking out a lot of retail investors. The apparent drop to a 70-cent quarterly dividend is purely a mechanical result of the corporate restructuring and that 1-for-2 reverse stock split we talked about. It is not a fundamental dividend cut in the traditional sense. That being said, at a roughly 1.3% yield, if you're buying this stock primarily for income, it's just not the strongest reason to own it anymore. This is firmly a growth and margin expansion story now.
So where does that leave us? Let's jump into part 4, our final verdict, and figure out how to navigate this crossroads.
Despite everything, the stock correction, the debt, management has confidently raised their 2026 outlook. They are doubling down, firmly banking on immense operational leverage to hit that $8.05 to $8.35 earnings per share target, all while generating roughly $2 billion in free cash flow. They fully expect to expand segment margins up to 20.5%. Look, if they actually hit these targets, the current stock price is probably going to look like a massive bargain in hindsight.
But, as market analysts pointed out after parsing through the recent earnings call, whether the legacy debt, the complex corporate actions, and the fundamentally lower revenue base cap its upside, it literally all boils down to their ability to execute. This quote perfectly sums it up. Keep your eyes on those margins. That margin expansion is doing almost all the heavy lifting for the expected EPS growth. If margins stall, the whole story stalls.
So what's the playbook right now? Well, because the underlying earnings outlook remains incredibly strong and management actually raised their guidance, the broad consensus is that this is absolutely not a fundamental sell. If you're a long-term investor or a new investor looking to get in, the strategy here is cautious accumulation. Don't chase it, but definitely watch those dips. And if you're already an existing shareholder, there really just isn't enough evidence to panic sell right now. The backlog and order growth still strongly support the long-term thesis.
Which brings us to the ultimate question you have to ask yourself. If you are analyzing this stock, this is the single most important thing you need to answer before you even think about buying the dip. Can Honeywell actually turn these strong orders and this promised margin expansion into sustainable earnings growth? Because if those orders start falling or the margin expansion suddenly disappears, the entire thesis flips. But if they can execute, this post-spinoff transformation could be the start of something truly special. So what do you think? Does the premium valuation and the massive debt scare you off? Or is a $20 billion backlog simply too good to ignore? Keep digging, keep analyzing, and I'll catch you in the next explainer.